This shows that the current fall in gold prices in dollars is not affecting the sector fundamentally. If it was, then gold stocks would be falling in gold ounce terms in anticipation of a fall, continued fall in the gold price and in gold equities, which is not happening at all. Will this be the domino that causes it? I don't know, but it could very well be big enough to cause the next domino to fall, which will eventually collapse the currency and lead to the end game that we have all been waiting for.
If we look at it from the low to the high, we had a 40% gain in gold. That's what I was trying to look at, compared to a 162% gain in silver. So in the case of silver versus gold, the precious metals are definitely in a rally mode.
Gold remains range-bound as a stronger US dollar and uncertain geopolitics limit upside and keep price action subdued. The bullish structure stays intact, with a breakout needed to trigger the next move higher, while key support continues to hold. Even though both gold and silver have pulled back since February, precious metal prices remain elevated, and year-to-date, both gold and silver are up about 10%, even with the pullback. Veteran experts Rafi Farber and Gary Wagner bring together two complementary perspectives on the financial markets. In this video, Rafi Farber notes that a major risk is building within the private credit system, where companies are struggling to repay debt due to sharply higher rates. Many firms backed by Wall Street financing models are becoming financially unstable, which in turn puts pressure on private credit funds and their investors. Farber compares this situation to the 2008 financial crisis, suggesting it is a similar credit bubble, but under a different structure. Regarding the broader financial outlook, Rafi Farber predicts that mounting stress in credit markets could escalate into a wider financial breakdown. This could ultimately trigger a final bank run, where investors rush to convert paper assets into tangible stores of value such as gold and silver. Despite short-term price volatility, he emphasizes that gold's core strength remains intact, which is evident in the resilience of mining stocks, indicating that deeper systemic risks continue to support its long-term upward trajectory. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from Rafi Farber and Gary Wagner recent interview.
All of these small businesses becoming bigger businesses with more efficiency but less flexibility. But the companies that are borrowing money from Wall Street to roll up all of these businesses cannot pay back their loans. Why? Because interest rates went from 0 to 5. And so the bank in this case, which is the private credit fund, cannot pay back its investors because the companies that it was rolling up cannot pay back their loans. And this will continue to disintegrate until the Fed bails everyone out. And then you have even more credit in the system. And all of this roll-up is going to have to be rolled up into one giant ramjack corporation company until you have only one company running the entire planet, which of course is impossible and the currency will collapse before then. But that is theoretically where this all heads. The private credit crisis is essentially the same thing as the subprime crisis of 2008, just in a different name. In subprime, lenders had to go out on the risk curve to lend money to consumers to buy houses that they couldn't afford. The private credit crisis is the same thing, where Wall Street firms have to go out on the risk curve to get return for their investors to lend to crazier and crazier debtors who cannot repay the loan. Just as George Bailey was experiencing a bank run at his bank, now the private credit firms are experiencing a bank run on their banks. If this bank run didn't happen, then what would end up happening with ever increasing amounts of credit is the hyper efficiency of the entire structure of production to the point where the roll up would continue at such an extreme pace that there would be one company rolling up everything into itself, and production would be limited to processing of dead bodies for food for the living who wouldn't have to do anything but wait for people to die so that they could be consumed in a soylent green manner. Therefore, nobody would have to do anything. Everything would be hyper efficient and life would be death. But before that happens, there will be the final bank run. That is what hyperinflation is. It is the final bank run on the Federal Reserve itself, because the Federal Reserve issues shares on itself, which are dollars, just as George Bailey's bank issued shares, which could not be redeemed for dollars that they ultimately represented. The Federal Reserve issues shares for its share of gold that it owns. Its shares are called dollars, and the final bank run is going to be people who own those dollars trying to return them for their original money, which is, of course, gold. But the Fed is not going to give gold for those dollars. So all of those people are going to have to go to coin shops and try to get gold and silver in return for their dollars, many of which will not be able to get any at all. And so the question is this private credit bank run big enough to spill over into a large enough bank run to eventually force the Fed to print even more tickets for federal debt and thereby destroy the currency as it causes the final bank run before everything ends up in one giant ramjack corporation where people are eating nothing but Soylent Green and doing nothing with their lives. One hint that yes, this is a developing credit crisis is that the value of gold has not really declined since it topped in dollars at about 5,500 at the end of January. How do I know that it hasn't declined? Because gold stocks have not fallen priced in gold at all since the gold top at the end of January. If you look at the gold to Huey ratio, that is gold stocks priced in gold ounces, the lower this chart goes, the more valuable gold stocks are in gold ounce terms. You can see here, this is 2026, and this is where we are now. This is the end of January, and we had a momentary fall in the value of gold stocks relative to gold, but we're right near highs, 4-5-year highs from 2020 over here. And we haven't fallen much at all. We're at 5.66, and I think the high is about 5.2. This shows that the current fall in gold prices in dollars is not affecting the sector fundamentally. If it was, then gold stocks would be falling in gold ounce terms in anticipation of a fall, continued fall in the gold price and in gold equities, which is not happening at all. Will this be the domino that causes it? I don't know. But it could very well be big enough to cause the next domino to fall, which will eventually collapse the currency and lead to the endgame that we have all been waiting for, which will de facto end all wars because they will not be able to be funded anymore by the dollar, which funds all of the violence currently ongoing on the planet.
During the interview, Gary Wagner explains that gold has delivered a strong upward move over the past year, reaching a peak near $5,600 before entering a corrective phase. He mentions that after forming a lower high and a deeper pullback, gold has started to recover, with the $4,900 zone now acting as a key resistance level. This area is critical because it previously served as support, highlighting how price levels often shift roles in market structure. Wagner uses technical tools such as Fibonacci retracements, moving averages, and momentum indicators to suggest that gold is attempting to rebuild strength after a normal correction. Moving forward, he predicts that gold could eventually retest the previous highs near $5,400 and beyond. In comparing metals, he points out that silver has significantly outperformed gold during the rally phase, delivering much larger percentage gains, but also tends to be more volatile. Overall, both gold and silver remain in a broader bullish trend, with current price action reflecting a healthy consolidation before the next potential leg higher. Silver also has a constructive position, which has been maintained above key levels, and upside potential is being developed. In the short term, both metals remain range-bound, but the overall picture still points towards an upward move as soon as a strong catalyst emerges. Let's jump into the interview.
Considering what gold has done, if you look back even a year to date or a year ago, we were looking at much lower numbers. Of course, we've got our line in the sand on the top now. That occurred on the 29th day of January when gold actually topped 5,600. From there, it would make the first of two lows. The first one came in on Monday, the 2nd of February, and gold traded down to about 44.60. Then it made a secondary high, and that's where I'm putting my fib retracement, and I'll explain why in a second. And from there, we had a really, really deep correction. That deep correction took us to about 4,100. That's the 23rd day of March. And from there, gold has been moving higher. If you notice on my chart, I've got a long rectangle, and that rectangle is pretty much surrounding 4,900. That is where I've been looking at technical resistance. Now, it was former support back in the middle of February. The way I was taught and the way I look at support and resistance is they are part and parcel of the same thing. If you're on the second story in your house or in an apartment building and you look down to the ground, that's the floor, and you bang on that floor, that's supporting you. But if you're downstairs on the first level, you look up to your ceiling, it's the same structure. So when you think about support and resistance, realize that at some point, those numbers are support. On the way down, it finds a level at which traders are believing that it's a good price to enter the market, and that will support it because, of course, they'll begin to buy or liquidate short positions. And if it does break below that, as gold did on Wednesday, the 18th of March, closing roughly at 49 and change, and then breaking below, opening the following trading session at about 48.58, and that's where we fell to this extreme low. And so by doing that, we can see that the current recent highs that came in this week, or the challenges, happened right below 4,900. 4,800 is important, but the number I think we need to focus on is 4,900, because that's where gold has been challenged to break above that. The key, though, when we look at gold, and I'll try to pick another chart, okay, where we look at gold, it has moved from the end of October 2025 from 4,000 to 5,600, $1,600 move. When it retraced, the bottom of that retracement is where I mark my 100 or 0 point on the fib level. But the secondary high that we had was a lower high, and then we had a lower low. Typically, in a market where you get a lower high and lower low, is significant in that it could be really anticipating what we call a level of support or resistance that's just been broken. And the one thing that I tend to do to confirm or deny that basic assumption is put up my moving averages. I'm going to do that right now. I've also added the MACD. And so what we can see is that when we look, first of all, at our stochastics, you can see how it dipped and is now below, or went below 20. For those unfamiliar with this technique, all a stochastic oscillator is, and we use oscillators and momentum. The oscillator is basically plotting a line comparing the highest high over a certain period to the current high. And so when the stochastics come down like this, it becomes extremely overbought. This is what we saw back in March. You can see where it got very top heavy back in January, and it broke above the 80 and here below the 60. So we've seen a real significant move up on the stochastic. We have also seen that on the MACD, which is simply moving average convergence divergence. We are not quite overbought yet, but we're getting in that territory. When you look at commodities versus stocks, a stock that has been trending higher for a year, even with dips along the way, will consistently be overbought because the price target keeps moving up, that level keeps moving up. We're seeing that in gold, whereas we're not range bound on a longer term basis by any means. We hit an all-time record high. We did get a lower high, then we did get a lower low. What we really need to see, and I believe there's a good chance of it on a technical basis, is this current rally, which began after that extreme low of 4,100, breaks through 4,900. Because if we do that, there's really no resistance till about 5,100. And then the basic brass ring, let's say, the point to reach is going to be to take gold prices over 5,400. And if that happens and it's still sustainable, that's when we'll challenge the new record high. that came in this year. Much in the same way, when we look at gold and silver, what we've seen is the phenomenal rally end of October. In the case of silver, $46. By the time it's done climbing, it's over or close to 120 an ounce. And this happens over 63 bars daily chart, so that means days. And what I want to focus on is the actual percentage gain. 162% gain in gold. It's not quite that good. I mean, if we look at it from the low to the high, we had a 40% gain in gold. That's what I was trying to look at, compared to a 162% gain in silver. So in the case of silver versus gold, the precious metals are definitely in a rally mode first. Secondly, silver is the proverbial candle lit at both ends, meaning it's burning brighter but lasting twice as long. In other words, on the way up during a period of when the precious metals are rallying, what we see is silver outperforming gold by a great deal, 160% to 40% in terms of it. The tact of the actual angle moving up is approximately the same, but it's gaining much more ground as they move to their new all-time record highs, both gold and silver.
Finally, concerns about the stability and ongoing devaluation of fiat currencies, especially the US dollar, have many countries looking to secure their own finances with gold and silver. Silver continues to build a base above key levels, supporting a broader bullish outlook for precious metals once a clear catalyst emerges. An appreciation of the dollar will make gold more costly and decrease demand in the short run. Consequently, the gold is falling below $4,800 amid continuous geopolitical uncertainties. The uncertainty favors the dollar over gold at the current time, and this continues to press gold until a clear direction emerges. If gold and silver are currently in a consolidation phase with strong long-term fundamentals, will the next breakout be driven by a financial shock or a gradual shift in investor confidence toward hard assets? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.